The United States' biggest headache isn't the sheer size of its national debt, it's the interest rates attached to U.S. Treasury bonds. As the issuer of the world's primary reserve currency, Washington only views total debt as a paper balance sheet number. The real threat is the steady cash drain from sky-high interest payments. Simply put, America doesn't mind owing massive sums of money. What it cannot sustain is debt servicing costs outpacing the capacity of its domestic economy to foot the bill. This pain has grown far worse since the traditional dollar-tied strategy lost much of its bite. Now, the U.S. stock market rally has become Washington's primary tool to repair its national balance sheet. Its core playbook breaks down into two scenarios. 1. Fuel a massive bull market. If this rally successfully spearheads an AI industrial revolution, artificial intelligence will become a permanent new growth engine for the U.S. economy. 2. If the bull market fails to deliver on expectations, policymakers will let an unprecedented stock market crash unfold to siphon global liquidity back to American shores. Major global events unfolding over the past several years may look disconnected on the surface, yet every single one is a calculated move to draw international capital and defuse the U.S. Treasury debt crisis. Round 1. The 2022-2024 Capital Showdown. February 2022, the Russia-Ukraine war erupted, designed to drive global capital towards safe haven jurisdictions. March 2022, the Federal Reserve launched aggressive rate hikes, luring capital into high-yield U.S. assets. September 2022, CHIP launched, funneling investment toward high-growth AI opportunities in the U.S. This coordinated three-pronged campaign all pointed to one destination: America. For every other country worldwide, there were only two terrible options. 1. Skip matching Fed rate hikes, triggering mass capital flight and a currency collapse. 2. Mirror U.S. tightening, sparking fire sales and plummeting prices for all domestic assets. China navigated a singular viable path through this storm. It refused to follow the Fed into rate hikes, instead cutting domestic interest rates and allowing modest controlled currency depreciation to shield export competitiveness. At the same time, industrial upgrading paired with homegrown landmark AI models like DeepSeek created enough domestic growth momentum to resist America's capital vacuum effect. By September 2024, the Federal Reserve began cutting rates, while China rolled out a full suite of pro-growth macro policies. The A-share market staged a sharp rally. While most other nations suffered severe capital outflows in this first round, no major sovereign debt meltdowns materialized, meaning the U.S. fell short of fully hitting its strategic targets. Round 2, escalating tensions between the U.S., Israel and Iran. To present day, the U.S. Israel-Iran conflict broke out in February 2026. Come May, Anthropic surpassed OpenAI in both valuation and revenue, alongside the IPO rollout of three flagship AI giants including SpaceX. Between May and June, market pricing for future Fed rate hikes surged once again. Market dynamics this cycle have grown far more extreme. The AI growth narrative has pulled liquidity out of nearly every other asset class. Safe haven stalwarts that held value during round 1, gold and Bitcoin, have both crumbled under the capital exodus toward tech stocks. The global AI power structure is now largely set. The U.S. holds unchallenged market leadership. Japan, South Korea and Taiwan capture secondary slices of the supply chain profits. China follows a separate playbook centered on cost-effective localized manufacturing and full domestic industrial substitution. China has taken active defensive measures to break foreign capital extraction channels. Large institutional investors have voluntarily reduced position sizes and shifted to a wait-and-see stance, while regulators tightened rules to curb cross-border capital outflows. This represents a state-level defensive strategy intended to calm market volatility and safeguard domestic capital reserves. 3 likely long-term scenarios for the U.S. stock market. No one can predict market moves day to day with perfect accuracy, so there is no definitive answer on whether a U.S. stock crash is inevitable. Below are the 3 most probable future trajectories. 1. Soft landing condition. AI technology matures to the point it no longer requires constant external capital inflows. The AI industry achieves sustainable commercialization and generates self-sustaining profits independently. 2. Hard landing condition. AI's commercial viability fails to materialize, investor confidence in the AI bubble evaporates, triggering an epic crash across U.S. equities. 3. Global liquidity crunch condition. Gold and Bitcoin experience steep collapses, and major overseas markets in Europe, Japan and South Korea reach breaking point. The U.S. AI bubble loses its external capital funding source, sparking a historic deep market correction. Until a final outcome crystallizes, two market mantras hold true. AI growth names have no clear ceiling, while consumer sectors have yet to hit a lasting bottom. Markets will keep swinging to ever more extreme extremes. Leading AI and tech stocks will repeatedly print new highs amid broad turbulence, while most other asset classes will stage brief dead cat bounces before resuming slow, drawn-out declines. Actionable trading rules for the current hyper-polarized market. Against this extreme macro backdrop, every investor must assess their personal risk tolerance and stick rigidly to trading disciplines aligned with their strategy style. 1. Momentum. Right-side traders. If you trade alongside prevailing trends and take light positions in the leading AI rally, enforce strict stop-loss orders without exception, aim to capture short-term speculative momentum profits, enter and exit rapidly, and never hold positions long-term. 2. Defensive, conservative investors. Your core strategy is position reduction. Do not chase outsized, bubble-era returns at the cost of your principal. Maintain ample cash reserves, and wait patiently for historic buying opportunities once a broad liquidity crisis ripples through global markets. 3. Contrarian, left-side bottom hunters. Avoid rushing to buy assets perceived as oversold for a quick rebound. With U.S. market sucking up nearly all global liquidity, neglected laggard sectors, including select consumer and traditional industrial stocks, will likely face further capital drain. Apparent lows can easily drop far lower. Additional critical risk reminders. Steer clear of overexposure to highly leveraged assets. If the third liquidity crunch scenario unfolds, every asset category will face indiscriminate mass sell-offs. Prioritize assets with clear fundamental certainty. Target stocks that hedge against external geopolitical and financial risks, rely on domestic substitution industrial logic, and carry genuine consistent profit streams. Steer clear of pure speculative concept plays with no earnings backing. In markets with extreme performance divergence, cutting losing positions to double down on market leaders is an unbreakable rule. Value rotation will eventually arrive. Yet until the current bubble fully deflates, never underestimate the power of a sustained trend. Do not tie up your entire capital, holding on to underperforming assets destined for prolonged bearish drift.